Markets have surged to record highs very recently.
Absolutely. And it's something important for us to remember is that this whole rally started 3 months ago when President Trump said, okay, we're going to delay tariffs for 3 months. And since then, the markets kind of took all this as, oh, great, he's delayed it. He'll delay it again. He'll do whatever it takes to get a deal and everything will be fine and happy again.
While the world's attention is scattered across headlines and distractions, something far more significant is quietly unfolding behind the scenes. The Trump administration has set a hard deadline to finalize a new round of tariff negotiations. The outcome? It could either spark a wave of new trade deals or escalate into a full-blown economic standoff. But here's what matters for you as an investor. If tariffs go up, foreign imports become more expensive. And when that happens, US-based companies, especially those that manufacture, move, and sell products within America, suddenly become a lot more valuable. That's the quiet opportunity building right now. Forget the flashy tech plays. Today's video is about 3 made-in-America stocks, all trading under $20, that could benefit directly from this policy shift. They're not trending yet, but they're moving, quietly, strategically, and in ways that smart money is starting to notice. Each of these stocks has something the market is desperate for: U.S. infrastructure, domestic supply chains, and the potential to surge if tariffs shift the playing field in their favor. So, if you're serious about catching breakout moves before they make headlines, hit that like button, subscribe, and turn on notifications. And by the end of this video, you'll know exactly which companies to watch before the headlines hit. Let's kick things off with a company that sits at the center of America's industrial backbone, Cleveland-Cliffs, ticker symbol CLF. As Trump's tariffs is targeting foreign steel or raw materials and the need for made in American, this stock could explode. Here's why. Cleveland-Cliffs isn't just a steel manufacturer, it's a fully integrated operator. That means it controls the entire supply chain, from mining its own iron ore to refining and rolling out finished steel, all within U.S. borders. That's rare. And in a world where foreign steel might soon carry a tariff premium, that independence becomes a strategic weapon. Think about this. Imported steel from China, Brazil, or even the EU could soon become 10 to 20% more expensive overnight if tariffs go live. But Cliffs? Their costs remain unchanged, while demand for their U.S.-made steel could surge from auto manufacturers, appliance companies, and federal infrastructure contractors trying to avoid tariff hikes. Now, let's talk about price action. As of this week, CLF is trading just above $8 after gaining nearly 17% in the past 30 days. That's not retail hype, that's institutional interest reacting to macro policy shifts. The stock recently broke above both its 50-day and 100-day moving averages, signaling strong upward momentum. Traders see this as confirmation of a trend reversal. And here's where it gets more interesting. The next key resistance level is sitting around $12.50 to $14, which lines up with its 200-day moving average. Break that and the stock could push into multi-month highs, possibly retesting the $20 to $22 range, which we haven't seen since early 2023. But what about fundamentals? CLF currently trades at a forward PE of around 9, well below the sector average. That suggests the stock is still undervalued relative to its earnings potential. Its balance sheet has improved dramatically over the past 18 months, and the company has been aggressively paying down debt, a signal that it's preparing for a longer-term expansion cycle. Analysts? They're slowly waking up. The consensus price target is hovering around $18.50 to $19, with bullish firms targeting $30 to $40 in the coming days if industrial demand picks up and trade restrictions tighten. And here's what most people miss. Cleveland-Cliffs was once a takeover target when it tried to acquire U.S. Steel. That deal didn't happen, but the move showed how serious CLF is about dominating the domestic steel space. If new tariffs come into play, expect more M&A speculation, more institutional attention, and a potential re-rating of the stock. Bottom line, Cleveland-Cliffs isn't just a play on steel. It's a bet on American policy, supply chain sovereignty, and industrial resurgence. If the tariff shift triggers a buy domestic wave, CLF could be one of the biggest beneficiaries, and it's still trading under $20. This stock deserves a place on your watch list. And if you're a long-term investor who believes in reshoring, infrastructure, and American self-reliance, this could be your moment to get in before the rest of the market wakes up. If you're looking for a U.S. stock that quietly prints money while the market fights over oil prices, Energy Transfer ticker symbol ET should be on your radar. This is one of the most underappreciated energy plays in America. While oil producers get all the spotlight, Energy Transfer operates behind the scenes, moving the oil, the gas, and the natural gas liquids across the country. It owns and controls more than 125,000 miles of pipeline infrastructure in the U.S. That's huge. From Texas to the Midwest to the Gulf, Energy Transfer is the link between production and consumption. But here's the twist. Unlike oil companies whose profits rise and fall with crude prices, ET operates more like a toll booth. They make money every time a barrel or cubic foot of energy moves through their pipes, regardless of whether oil is at $60 or $90. So, what does this have to do with tariffs? Well, in a world where international energy trade is getting more expensive or politically sensitive, companies with massive U.S. infrastructure become more valuable. Energy Transfer doesn't rely on shipping through foreign ports or overseas deals. Its entire business is here in the States, and that's a serious advantage when protectionism is on the rise. Let's look at the chart. Over the past few months, ET has been consolidating in a tight range, hovering just below its 100-day simple moving average. That might sound dull to traders chasing hype, but for smart investors, this kind of setup often precedes a breakout. In the last few trading sessions, we've seen ET test that 100-day line twice, but fail to break through. Think of that as a pressure valve building strength. If it punches through convincingly, the next move could be fast and sharp. The MACD line is hovering right around neutral, but a clean bullish crossover could flip sentiment quickly. Now here's where it gets even more interesting. Energy Transfer pays a dividend yield of over 8%. That means even if the stock doesn't explode tomorrow, you're getting paid handsomely while you wait. That's rare for a stock trading around $20. As for valuation, ET is dirt cheap, trading at just 8 times forward earnings and under 1x price to sales. This company throws off billions in cash flow annually and has made serious progress on reducing debt and strengthening its balance sheet. So, what's the upside? If Energy Transfer breaks out above resistance and sentiment in the energy sector shifts, which often happens quickly, you could see the stock move to $21.50 or even $24, according to several analyst targets. That's a 20–25% move in addition to the high-yield dividend you collect along the way. But the real upside here is strategic. As global tensions rise and tariffs reshape trade flows, domestic infrastructure becomes essential, and few companies own more of it than Energy Transfer. This is the kind of stock that doesn't beg for attention, but it rewards patience, and it thrives in the background while the rest of the market chases noise. Our third stock is one that many investors have left for dead, but that could be a serious mistake. Newell Brands, ticker symbol NWL. This isn't just another consumer products company. It's a sleeping giant with deep American roots, and right now, it's showing signs of waking up. This is the company behind household staples like Rubbermaid containers, Sharpie markers, Coleman outdoor gear, Elmer's glue, and Yankee Candle brands that have been trusted in American homes for decades. Over the last few years, NWL has struggled. COVID-era demand spikes faded, supply chains broke down, and the company's stock collapsed from over $20 in 2021 to under $7 in early 2024. But here's what Wall Street isn't talking about. Newell has been quietly restructuring its business. They've cut costs, refocused on core brands, simplified their supply chain, and most importantly, they've brought more of their manufacturing and distribution back to U.S. soil. And with a global tariff realignment on the horizon, that move could prove brilliant. If tariffs tighten on imported consumer goods, Newell instantly becomes more competitive. It won't be dragged down by overseas shipping delays or border taxes. That's a major advantage in a globalized market facing rising protectionism. Let's talk price action. In the past 30 days, NWL has surged over 17%, pushing above its 100-day moving average, a key technical indicator traders watch for bullish confirmation. More importantly, momentum is building. The MACD, a momentum indicator, has just crossed into bullish territory, suggesting buyers are gaining control. If this rally holds, the next target is the 200-day moving average around $7.50, and a breakout above that could send the stock toward $9 or even $10, which is where analysts like Barclays see it heading. That's up to 30–40% upside from current levels. But this isn't just about charts. This is about valuation. Newell is trading at a price-to-sales ratio under 0.5, meaning the market is valuing this company at just half of what it earns in revenue. For a business with a portfolio of iconic brands and improving margins, that's a deep discount. Even if Newell doesn't fully recover to its pre-2021 highs, there's still massive room for appreciation. And if tariffs give U.S.-centric companies a demand tailwind, NWL could be one of the best-positioned small-cap rebound plays on the market. Bottom line, this is a turnaround story with upside potential, technical confirmation, and a macro tailwind coming straight from Washington. Smart investors should keep a close eye on Newell before the July 9th tariff deadline hits, because by then, it may already be too late.